Hi, I'm going to dive right into the market report for this last month, and we're going to look at what we're seeing nationally. And at the end, we're going to look at how we stack up locally, how our local numbers stack up against what's going on in the nation. So I'm going to walk you through three of the most important topics happening right now in the housing market. We got mortgage rate projections from the experts, home prices and what's going on there, and home affordability, something that's definitely top of mind for almost everybody right now. To start with mortgage rates, this is a look at the Freddie Mac 30-year fixed rate going all the way back to January of 2022. What it shows is how much mortgage rates really rose from the beginning of the year all the way to about mid to late June-ish. And then since then, you could see that there's been a lot of volatility or fluctuation in the mortgage rates over the last few months. So why is that? Well, inflation is the enemy of long-term interest rates, as we know, and that's certainly something that we are all keeping an eye on. We know that the Federal Reserve doesn't actually call out the mortgage rates, but they're certainly making moves right now to ease the inflation, to pump the brakes on the inflation. And when that happens, the mortgage rates tend to respond. So where are the mortgage rates headed? Well, if we look at these projections from Freddie Mac, Fannie Mae, MBA, and NAR, this is the latest data that we have as of August of this year. And if we average all of the projections together over the next 4 quarters, what we can see over in the right-hand column is that mortgage rates are projected to essentially stabilize over the next year. So that's definitely what we're looking forward to, and hope that the experts are correct on these projections as we continue to watch all the economic drivers that are going on around us. And I think as we look at this, low to maybe mid fives is the projection. Maybe even by the end of next year, we might be dipping into the high fours. That could bring a lot of predictability for the buyers, and I think that this next quote really says that well. So this is from Lisa Studevant, a housing market economist that we follow. She says this: after the end of the summer lull and as mortgage rates stabilize, we may see a return of buyers and a relatively strong fall housing market. So that could be great news. If mortgage rates do stabilize, we may see more buyers coming back into the market. We certainly know that rising mortgage rates have caused many buyers to step out of the home buying or selling process. But with these projections at hand, should they actually play out, we could see some of the stabilization in that, and a very strong fall housing market could follow. So another topic that's on everybody's mind is home price appreciation. What's happening with the home prices? Where are the home prices headed? So what I'm going to go to do is break down today's home price appreciation, because this is really kind of a complicated topic. So with our market here locally being on the West Coast, we have a little different situation than the rest of the country since we're in an overheated market. We're seeing prices decline as less buyers are active on the market. We've come off the high of the 20 to 25% year-over-year home price appreciation, and it's been cooling off for a while. Home prices were still at 15.8% higher on the national average compared to last year. But that's a slower pace than the high of the over 20 to 25% over that we saw the beginning of this year and the end of last year. So the pace of appreciation is slowing. That's deceleration. So we're all going to keep our eyes on the month-to-month changes in the market. And truthfully, what this means is that a year ago, the listing price was the floor of the negotiation. You could list a home and you could maybe list it a little higher than what you thought it would go for or what it was worth. And then buyers would come in, multiple buyers, multiple offers, bidding wars, bidding the price up on the home. The price was the floor of the negotiation, basically. What's happening now in today's market, on the West Coast anyways, is it's been shifting. So the list price is probably more of a ceiling of the negotiation. Buyers have a little bit more negotiating power now than they did the last couple of years. We're seeing changes month over month, and that's what we're keeping our eyes on. We know the past 2 years have been an anomaly. The price growth over the past year in particular was just unsustainable price growth. Looking ahead, CoreLogic expects to see a more balanced housing market with year-over-year appreciation slowing to 3.8% by July of 2023. Leading up to the pandemic, the average typical home price appreciation over a typical year was about 3.8%. So that's what we're starting to see again. If mortgage rates had not risen as much as they had, we would not have been able to slow buyer demand. And the year progressed, so they realized the inventory was still pretty low. Buyer demand is softening, but the inventory is still low. So what's happening here? As we look at this data from calculated risk, this helps us compare where we are today versus where we were over the past few years. So if you look at the blue bar all the way on the left, you can see that the inventory is 26.3% higher than it was the week ending September 2nd last year. So year over year comparison for the last week of August and into the first couple days of September, 26.3% more inventory. So that's creating more opportunities for the buyers. It's helped with softening of the home prices for sure, but compared to the same week in 2020, inventory is still down 5.4%. And compared to 2019 before the pandemic, it's 42.2% below where we were the same week as 2019. So that's what's continuing to drive the pressure on the home prices because the inventory is still low. Yes, we've seen a cooling, we've seen a softening, we've seen a slowing, we've seen a lowering of list prices, but home prices are projected to continue rising at a regular rate based on this inventory data. Let's talk just a minute about affordability. Housing affordability right now is lower than it's been all the way back to the 1990s. This graph is going back to 1990 and showing the housing affordability. The way you read this is the higher the bar, the more affordable a house is. And right now, you can see we're in the red. The red is lower than it has been since the 1990s. And what stands out are the years after the housing crisis, where distressed properties dominated the market. Those are the lines in the blue. The high of the market, the Housing Affordability Index reads 197. Right now, we're at 98.5. The way you read this is 100 of the reading Housing Affordability Index is really an even reading. And right now, the average household can afford 98.5% of the average mortgage payment, so less affordable. Homes are less affordable right now, and mortgage payments have been increasing. No doubt, as people have gone through the pandemic, the meaning of home changed quite a bit. So you know that people are willing to pay more for what they want right now. We're seeing that right now in raising mortgage payments across the country, just not on the West Coast. Another thing we want to look at is when we start to break down the affordability and understand that this is what we want to look at when we're looking at the average mortgage payment or income committed to a mortgage payment. So right now that sits at 25.4%. That assumes that a 30-year fixed mortgage rate with a 20% down payment on a median priced home with median income. So go back to the affordability equation. The median income, the median priced home, somebody is dedicating 25.4% of their income to a housing payment. So why is this important? Well, if you look at us in the West, the qualifying income, what you need to actually make in order to purchase a home, is certainly significantly higher than what the median income is. So in the West, we're less affordable. No surprise there, right? In the South, they're neck and neck. In the Midwest, the median income is higher than the qualifying income. So I guess that's what the price we pay for living in California, right? All right, so we're going to switch gears. Let's touch base on what our numbers look like locally and how it compared to last year. For Santa Maria in August, the average price home was 9% higher than it was last year, but it took 7 days longer to get us into contract. We have more inventory coming onto the market over what we had last year, with an 11% percentage more homes hitting the market today, August of 2022, than August 2021. As far as Orchid area goes, we had a 5% increase in the price over last year. So the average price home is $636,900. That's in August 2022. Average days on the market more than doubled. Last year, it took us 11 days to go under contract. In August of this year, it took us 26 days to go pending. The number of new listings remained about the same though. Last year, August, we brought 36 homes to the market. This year, we brought 35 homes. So that's about stagnant. Just as we touched on the national numbers, we're seeing quite a bit of difference here on the central coast of California from last year to this year. The normalcy is coming back to the market, how it was pre-pandemic, before all the craziness happened. Still short on inventory, but not the crazy overbidding and all that stuff that we had last couple years. And in a lot of cases, the buyers are able to negotiate better prices and better terms on their contracts. So I hope that this was helpful. If you ever have any questions, feel free to reach out. I'm Stephanie Souza with Modern Nest Realty. And if you have any real estate questions whatsoever, no strings attached, reach out. We're always here to help.